All right, let's dive into a topic that's pretty important for a lot of Canadians, mortgages. Whether you're a homeowner thinking of buying your first place or just curious about how this whole thing works, we're going to go deep on this today. And the best part, we're using official government resources from Canada.ca, so you know it's reliable info.
It's amazing what's out there on those websites. They really try to make this stuff easy to understand, which is important because honestly, mortgages can feel kind of like, well, the secret language.
Totally. It's like a whole world of terms and conditions,
Yeah.
but we're breaking it all down for no jargon, just clear explanations. And trust me, I was surprised by some of the stuff we found. Like, did you know you can actually break your mortgage contract?
Oh, yeah,
Sounds good, right?
it does.
But there's a catch. It can cost you like thousands of dollars.
Thousands, yeah. It's one of the many twists and turns we'll be exploring today. We'll also be looking at how to pay off your mortgage faster, potentially saving a ton of money on interest. And with interest rates being such a hot topic lately, we're going to dig into that stress test everyone's talking about.
How it impacts what you can afford.
Exactly.
Right. It's all about knowing what you're getting into. So, before we get to those juicy details, let's start with the fundamentals. What exactly is a mortgage in the simplest terms?
Well, at its core, a mortgage is a loan, usually a really big one that you take out to buy a property. But the key difference here is this loan is secured by the property itself. So it's like you're using your future home as collateral.
So it's like the lender saying, hey, we trust you'll pay us back, but just in case, we have dibs on the place.
Exactly. And we're not talking about borrowing 20 bucks from a friend, we're talking hundreds of thousands, sometimes millions of dollars. This is serious business, and there can be some pretty significant consequences if you don't hold up your end of the bargain.
Okay, so there's a lot of responsibility. Got it. So let's say we got the basics. We're ready to jump into the market, maybe even pre-approved for a certain amount. What are the big things we need to think about when actually choosing a mortgage?
That's when things get strategic. You've got a lot of factors to weigh. Things like how long you want the term of your mortgage to be, the amortization period, whether you go with a fixed or variable interest rate, and even how often you make those payments. Each of these decisions impacts your monthly budget and the total interest you'll pay over time.
Okay, let's unpack those a bit because I know they can be kind of confusing. Term length. That's how long you're stuck with the specific interest rate, right? So if rates go down after you sign, you're basically stuck with that higher rate until the term's over.
Exactly. And that's where the strategy comes in. A shorter term, like 1 or 2 years, gives you more flexibility if rates drop. But it might come with a slightly higher interest rate at the start. Longer terms, 5 or 10 years, they offer stability, but less wiggle room to take advantage of potential rate drops.
So it's like choosing between playing it safe or taking a gamble on where rates are headed, right?
That's a great way to put it. It depends on your comfort level with risk and whether you value predictability over potential savings.
And then there's amortization. That one always makes me scratch my head a bit. Is that just how long you have to pay the whole thing off?
Yep, that's it. Amortization is the lifespan of your mortgage, the number of years it takes to completely pay off the principal and interest. So if you choose a 25-year amortization, you're looking at 25 years of making those regular payments until you own the home outright.
So a longer amortization means smaller monthly payments, but you're making them for longer. Is that like always a bad thing?
It's tempting to go for the smaller monthly payments, sure. But here's the thing, the longer it takes to pay off the mortgage, the more you end up paying in total interest. We're talking potentially tens of thousands, even hundreds of thousands of dollars in extra interest.
Wow, that puts things in perspective. It's like the slow and steady approach might actually cost you way more in the end.
Exactly. And that's why it's important to not just focus on that monthly payment amount, but to really think about those long-term costs. It's about finding that balance between affordability and minimizing those interest charges.
Okay, so we've got term length and amortization, but then there's this whole fixed versus variable interest rate debate. That one seems to get everyone riled up.
Oh yeah, it's a big one. And it really comes down to personal preference and risk tolerance. A fixed-rate mortgage is like locking in peace of mind. You know exactly what your payment's going to be, even if rates go up. But you could miss out on savings if rates drop.
So it's like paying for a little insurance against those potential rate hikes.
I would say that, yeah.
What about variable rates? I know those can be a bit unpredictable.
A variable rate fluctuates with the market, which can be a little bit of a roller coaster. But the upside is that you might get a lower rate at the start. And if rates stay low or go down even more, you could save a good chunk of change.
But if they go up, Yikes, that's a risk some people might not be comfortable with, especially in this crazy market. Is there any way to, like, hedge your bets, or are you stuck choosing one or the other?
Well, there's actually a third option that people often forget about: the hybrid mortgage. It's like a mix of fixed and variable, so you get a bit of both worlds. Part of your mortgage is locked in at a fixed rate for stability, and the other part is variable, offering potential savings if rates go down.
So you're not just stuck with two extremes. You can actually tailor your mortgage to your risk level. I like that.
Exactly. And another factor that people underestimate is how often you make your payments. Choosing to pay more frequently bi-weekly or weekly can actually chip away at your principal faster and save you money on interest in the long run.
It's like sneaking in extra payments without feeling the pinch as much, right?
Right. Small tweaks can make a big difference over time, especially when it comes to something as big as a mortgage. Now, before we get too deep into all the different types of mortgages, let's talk about the elephant in the room, the thing that seems to be the biggest hurdle for first-time buyers: the dreaded down payment.
Ugh, the down payment. I know so many people feeling the pressure of saving up a huge chunk of cash. What's the minimum down payment required in Canada? Is there a magic number?
Well, the magic number actually depends on the price of the home. For homes under $500,000, the minimum is 5% of the purchase price. But between $500,000 and $1 million, you need 5% on the first $500,000 and then 10% on the rest. And anything over $1 million, you're looking at a 20% down payment.
So the pricier the home, the more you need to cough up front. Makes sense, but it definitely highlights how important saving is. And I've heard a lot about mortgage loan insurance. When does that come into play?
Great question. You usually need mortgage loan insurance if your down payment is less than 20%. It's there to protect the lender, not you, in case you can't make your payments. And it comes at a cost. That cost gets tacked on to your mortgage payments.
Ah, so it's kind of like a penalty for not having that 20% down payment, right? Are there any ways to avoid it, or is it just something you have to accept if you don't have that 20%?
Saving up that 20% is the best way to avoid the extra cost, for sure. But I know that's not always realistic. That's why it's good to know about any government programs or incentives that might be able to help.
Sounds like doing your research and knowing your options is key, especially when it comes to that down payment.
Absolutely. Speaking of hurdles, let's talk about affordability. It's a hot topic these days. We hear a lot about the stress test, especially with these fluctuating interest rates. What is that, and how does it affect getting a mortgage?
Yeah, what is the stress test?
It's a big deal these days. Basically, it's a way for lenders to figure out if you can still handle your mortgage payments, even if interest rates shoot up. They use what's called a qualifying rate. It's higher than your actual rate. It's like a worst-case scenario. And they calculate your payments based on that higher rate.
So it's like they're saying, okay, let's see if you can handle this even if things go south. Kind of intense, but I guess it's better to be safe than sorry, right?
Exactly. And the stress test isn't just a suggestion. It actually impacts how much money you can borrow. If you can't pass the test at that higher rate, you might not qualify for as big of a mortgage as you wanted.
So you might need to adjust your expectations, maybe look for a less expensive house, or come up with a bigger down payment.
Exactly.
Wow, so it's not just about your income and expenses right now. You have to prove you can handle those potential rate increases. That's a big takeaway for anyone thinking about getting into the market right now.
It really underlines the importance of not overextending yourself.
Yeah.
Just because you qualify for a certain amount doesn't mean it's the right amount for you. Make sure you're comfortable with those payments, even if rates go up.
Great advice. Okay, we've talked about what a mortgage is, what to think about when choosing one, and the stress test thing. But what about after you get that mortgage? Life happens. Maybe you have to sell sooner than expected, or maybe interest rates take a dive and you want to get a better deal. Can you actually break a mortgage contract? And what happens if you do?
That's an excellent question. And it's one we'll be diving into right after this break. Stay tuned to learn all about breaking those mortgage contracts and the potential costs involved.
Okay, so we're back and ready to tackle something that, well, might surprise some people. Can you actually break your mortgage contract before the term's up? I always thought those mortgage documents were like set in stone.
Yeah, it's a pretty common misconception. It's definitely the ideal scenario to stick with your mortgage term as planned. But, things happen.
Right.
Sometimes you got to sell your home sooner than you thought. Or maybe interest rates drop and you think, hey, I could get a much better deal now.
So you're not like totally trapped in that contract. There's actually some wiggle room.
There is, but it usually comes with a cost. Prepayment penalties. Lenders aren't always happy when you decide to break the contract early. Those penalties can be, well, Pretty hefty.
Okay, yeah, that's definitely a catch. So, before I get too excited about breaking free from my mortgage, I need to understand these penalties, right? What makes them higher or lower?
One of the biggest things is the type of mortgage you have, open or closed. Open mortgages give you the freedom to prepay or break the contract without any penalties, which sounds pretty awesome, right?
Yeah, it does.
But that flexibility usually comes with higher interest rates.
Ah, so you're paying for that freedom up front.
Pretty much. You get a slightly higher rate, but you know you can get out of it if you need to.
Okay, and closed mortgages, I'm guessing those are the ones with the scary penalties?
You guessed it. Closed mortgages usually come with lower interest rates, but there are stricter rules about breaking the contract. Those lower rates are basically a reward for sticking with the terms for the whole term. And if you break that commitment, well, you're probably looking at a prepayment penalty.
So it's a trade-off. Lower rates for less flexibility or higher rates for more freedom. Makes sense. But let's say I'm in a closed mortgage and suddenly interest rates plummet. How do I know if it's actually worth it to break my contract and go for that lower rate?
First things first, you got to find out exactly what prepayment penalty your lender would charge. It's usually outlined in your mortgage contract, but you can also just call your lender. They can give you an estimate based on your specific situation.
And is there like a standard way they calculate these penalties or does it like vary a lot between different lenders?
Oh, there's no one-size-fits-all formula, unfortunately.
Hmm.
Sometimes it's a simple calculation like 3 months interest on what you still owe.
Yeah.
But a lot of times, it's based on something called the interest rate differential, or IRD.
Okay, now we're getting into the confusing acronyms. What is this IRD? How does it work?
The IRD basically looks at the difference between your current interest rate and what rates are available right now in the market. So the bigger the gap between your locked-in rate and those shiny new lower rates, the higher your penalty is likely to be. It's like the lender's trying to make up some of the interest they would have earned if you'd stayed in your contract.
So I need to weigh the potential savings of a lower rate against the cost of breaking my contract. It's a numbers game.
It is, and you probably shouldn't do that math in your head.
Definitely not. So it's best to get those exact figures from my lender, right? To really understand what I'm dealing with.
Exactly. Once you know the penalty, you can compare it to how much you could potentially save with a new mortgage at a lower rate. Got to factor in everything, the new rate, any fees for setting up a new mortgage, and how much you'd actually save on interest.
Sounds like a lot to consider, but it's worth it to make a good decision.
Definitely worth it. You want to make sure the numbers make sense for you. Sometimes the savings outweigh the penalty, especially if you've got a big mortgage and a lot of time left on your term. But sometimes it's better to just finish your current term.
I'm starting to realize there's a lot more strategy to mortgages than I thought. We've talked about how breaking a contract can cost you, but sometimes it makes financial sense. Are there any ways to actually reduce those prepayment penalties? Or am I just stuck with whatever the lender throws at me?
There's some things you can do. One of the best strategies is to really make the most of your prepayment privileges every year.
Oh yeah, prepayment privileges. I've heard of those, but remind me, what are they exactly?
Basically, it's the extra money you're allowed to put toward your mortgage on top of your regular payments without any penalties. It might be a lump sum, a percentage of your mortgage balance, or maybe you can increase your regular payments by a certain amount. These privileges are different for every lender, so you got to check your contract for the details.
So if I use those privileges, I'm basically chipping away at the principal faster, which means less interest over time and maybe a smaller penalty if I ever need to break the contract.
Exactly. It's a smart move that can potentially save you money later on.
Oh,
And remember how we talked about shorter mortgage terms being more flexible? Well, that comes into play here too. If you choose a shorter term to begin with, you get more opportunities to renegotiate or switch lenders without facing those big penalties.
it's all about planning ahead.
It is. Planning and knowledge are key when it comes to mortgages. Now, I want to shift gears a bit and talk about something a little more positive. Paying off your mortgage faster. I think we all dream about being mortgage-free sooner rather than later.
Oh, absolutely. Who doesn't love the idea of owning their home outright? It's a huge accomplishment. And the sooner you get there, the more money you save, right?
You got it. So, besides using those prepayment privileges, what are some other ways to speed up that mortgage payoff?
Yeah, how can we make those homeowner dreams a reality?
Well, one of the easiest things you can do is just increase your regular payments, even if just a little bit. You'd be amazed at how much impact an extra $50 or $100 a month can have over time. It can shave years off your amortization and save you a ton on interest.
I've also heard of people making biweekly payments instead of monthly. Does that actually help? And how does that work?
It's a great strategy. When you make those accelerated payments, whether it's biweekly or weekly, you're basically squeezing in an extra monthly payment each year without really noticing it in your budget. That extra payment goes straight toward your principal, so you pay off your mortgage faster and save on interest.
So it's like a little trick to pay more, but in a good way?
Exactly. It's about finding those small adjustments that can make a big impact over time. Now, remember how we talked about the down payment and how it affects the total cost of your mortgage?
Uh-huh.
Well, this is where it gets interesting. I think this might be a bit of an aha moment for our listeners.
Okay, I love those. Lay it on me. How does the down payment play such a big role?
Okay, so imagine you're buying a $400,000 home. With a 5% down payment, which is the minimum for that price range, you're looking at a total cost that's including interest and mortgage loan insurance of over $640,000 over the life of the loan, that is.
Wow, that's over $240,000 in interest.
It's a big number. But here's the interesting part. If you bump that down payment up to just 10%, suddenly your total cost drops to a little over $625,000.
So just by adding another 5% to my down payment, I could save like almost $18,000.
Exactly. It really shows the power of that initial down payment. The more you put down up front, the less you have to borrow and the less interest you'll pay over the years. It's all about planning and saving strategically.
Okay, I'm sold on saving for that down payment. It's not just about getting into that house faster. It's about setting yourself up for success in the long run. But what about people who are struggling to save that much up front? It's tough, especially with everything getting more expensive.
It is a challenge. We've covered a lot today, from choosing the right mortgage to ways to pay it off faster. But what happens when life throws you a curveball and you just can't make those monthly payments? What kind of relief is out there?
Yeah, that's a reality for a lot of people. It's important to know what resources are available. We'll get into those mortgage deferrals and relief options after the break, so stay tuned. All right, we're back. And, let's be real. Sometimes life throws you a curveball, and those mortgage payments that felt manageable before can suddenly feel impossible. It happens. So what happens if you're having trouble keeping up? Are there any options out there?
Well, the good news is you're not alone, and there are options for relief. Lenders get it.
Mhm.
Financial hardship happens. They're usually willing to work with borrowers who are going through a tough time. The important thing is to be proactive. Reach out to your lender as soon as you think you might have trouble making a payment.
So don't just ignore it and hope it goes away.
Exactly. Talk to your lender. The sooner the better. The more time they have, the more options they'll have to help. One option that often comes up is a mortgage deferral.
Right. Mortgage deferral, I've heard that term, but I don't really know how it works. Is it like you just hit the pause button on your payments for a bit?
It's kind of like that. A deferral lets you postpone your regular mortgage payments for a certain amount of time, usually up to 6 months. It can give you some breathing room if you're dealing with a short-term financial setback, like maybe you lost your job or had some unexpected medical bills.
That sounds like a real lifesaver in a tough spot. But what about the interest during that time? Does it just disappear?
I wish. Unfortunately, interest keeps adding up, even if you're not making those regular payments.
Hmm.
And here's the thing. That unpaid interest gets added to your principal.
Hold on. So I'm not really getting out of pitching that interest. I'm just delaying it.
Yeah.
And it's going to come back to haunt me later.
Yeah, pretty much. And it's not just that the interest gets tacked on later. You could end up paying interest on the interest that's built up. It's called interest on interest. It can snowball if you're not careful.
Okay, that sounds kind of scary. So deferrals are not something to jump into without thinking it through.
Right. They're a short-term fix that can have some long-term consequences. And usually there are better options to look into before resorting to a deferral. One thing you can try is calling your lender and seeing if they're willing to renegotiate your mortgage terms. Maybe they'll extend your amortization period, which could lower your monthly payments.
But didn't we talk about how a longer amortization means you end up paying more interest overall? It feels like you're kind of stuck between a rock and a hard place. Lower payments now, but maybe a bigger cost in the long run.
Yeah, that's a good point. It's a trade-off. It's super important to understand what extending your amortization really means. It's not a decision to take lightly. Definitely got to crunch those numbers and see if it makes sense for your situation.
Are there any other features that some mortgages have that could offer some relief? Or is it pretty much just deferrals and renegotiating?
Well, some lenders have things like skip a payment options. That means you can skip 1 or 2 payments a year without any penalty. Could give you a bit of a break without messing with your long-term costs too much. Worth checking if your mortgage has any of those features.
Okay, those sound helpful. But what if I've tried all that and I'm still struggling? Are there any other options, or am I out of luck?
If you've tried everything else and you're in a situation where you might lose your home, your lender might suggest something called a sale by borrower plan.
Sale by borrower. What's that?
Basically, it's a way to sell your home at a fair price, but you can keep living there while you do it. The lender agrees to wait for the money from the sale to pay off the mortgage, gives you time to find a buyer and move.
So it's like a last resort to avoid, a foreclosure and to get out of the situation without things getting even worse.
Exactly. Get to keep some control and hopefully avoid a more stressful and expensive forced sale.
Okay, so we've covered what happens when things get tough. But what about when your mortgage term is almost up?
Oh, that's a great time. It's not just about paperwork. It's a chance to take stock of your situation, see what else is out there, and maybe even get a way better deal.
So I'm not like automatically stuck with the same lender and the same terms. I have choices.
You've got tons of choices. When that term ends, you're free to switch lenders or renegotiate with your current one. Don't just renew without looking around.
But isn't switching lenders a huge hassle? All that paperwork, sometimes it just feels easier to stick with what you know, even if it's not the absolute best deal.
I get it. Paperwork's no fun. But honestly, it's often worth it, especially if you can snag a lower interest rate with another lender. Even a small difference in your rate can add up to big savings.
You've convinced me I'm going to shop around next time. So, how should I approach this whole renewal thing? When should I start thinking about it? What should I actually do?
Start thinking about it a few months before your term's up. Gives you time to do your research, shop around, and get everything in order. First things first, know your rights. If your mortgage is with a federally regulated institution like a bank, they have to send you a renewal statement at least 21 days before your term ends. That statement shows you all your current mortgage details and the terms they're offering for renewal. But don't feel pressured to just take their offer. Look around.
So, I have some time to check out those terms, see if they actually work for me. What about checking out other lenders? When should I start doing that?
I'd say start shopping around a few months before your renewal date. That way, you have enough time to get pre-approved by other lenders, compare their offers to what your current lender's offering, and make a good decision without feeling rushed.
And what about negotiating? Can you actually negotiate with lenders, or is everything pretty much set in stone?
Oh, never underestimate the power of negotiation. Lenders are often willing to budge, especially if they know you're considering going with someone else. So don't be afraid to ask for a better deal.
This has been awesome. I feel like we've gone from Mortgage 101 all the way to the really important details. Any final thoughts for our listeners who are either dealing with a mortgage now or thinking about getting one?
I think the biggest takeaway is knowledge is power. The more you know about mortgages, the different types, the terms, the options, and yes, the potential problems, the better decisions you'll make.
So it's about taking control and making sure you understand everything instead of feeling lost and confused.
Exactly. And remember, you don't have to figure it all out by yourself. There are resources out there. Do some research, ask questions, and hey, if you're feeling overwhelmed, talk to a financial advisor. They can give you personalized advice.
Awesome advice. A big thank you to our expert for breaking it all down for us. And to our listeners, thanks for joining us for this deep dive on Canadian mortgages. We hope you learned something and maybe even feel a bit more confident about tackling this whole mortgage thing. That's it for us. See you next time.